In the last 2 years, I've been putting $200 every single month in my TFSA. I mean, I put the same amount and I buy the same ETF and it goes in on the same day. And the best part is I don't even check the price before this money goes in. And I also don't wait for a market dip. And I also don't think about it. So it just happens automatically and I just move on with my life. Now, most people who know anything about investing will call that dollar cost averaging, but it's not. And I want you to understand the difference and how it can change your investing strategy. So in this video, I'm going to break down what DCA actually is, what most people get wrong about it, and why my strategy is arguably better for the average investor. So let's get into it. Now, most people think dollar cost averaging means you invest a fixed amount of money on a regular schedule, like every month, instead of trying to time the market. I mean, that's close, like it's a very close definition, but it's missing a key piece of context. What dollar cost averaging actually means is you're investing a lump sum of money that you already have. Key piece. You're investing a lump sum of money that you already have sitting in cash. So let's say you have a $5,000 bonus, or you inherit some money, or you've been sitting on some savings for a while and you finally decide to invest it. The question is, do you put all that $5,000 in today? Or do you spread it out, say, $1,000 a month for the next 5 months, just to reduce the risk of buying in at the wrong time and at the wrong moment, right? Now, that is what dollar cost averaging actually is. It's a way to invest a lump sum of money over time, very different from putting that sum of money all at once in the market. Now, what I am doing differently is I don't have 2,400 sitting around. I don't have a lump sum of money sitting in one corner that I'm slowly dripping into the market. What I'm actually doing is I'm investing $200 as it comes in each month because that is what I can afford. So I'm taking $200 from each paycheck, just regular automated investing. Now, I'll show you how that actually works and how it makes sense for your investing strategy. So let's say XEQT ETF, right? And full disclaimer, I hold XEQT ETF, by the way. Let's say XEQT is trading at $30 a unit in January. My $200 buys me around 6.7 units, right? In March, if the market drops a bit to around like $27, that same $200 buys me 7.4 units. In June, if the market recovers to $32, that same $200 buys me 6.3 units. So regardless of market conditions, my $200 still goes in to buy whatever it can buy. I never made a single decision to buy more when it's cheap. It just happened automatically. It's just by investing a fixed dollar amount on a schedule. Now, when the price drops, my $200 buys more. When it rises, it buys less. Over time, my average cost per unit ends up lower than the simple average of all the prices I bought at. Now, the big advantage here is I have a reduced average cost basis, and it works in your favor, specifically in gradually declining markets, right? The catch here, which I'll get to in a minute, is that it doesn't always win. Now, whether it beats just going in all up front, it depends on entirely what the market does after you start investing, and nobody can predict that in advance. If you do have a lump sum of money, if you have a huge pile of cash sitting around in your house, should you invest it all at once? Or should you spread it out over a couple of periods of time? Now, I've looked at the real numbers, including Canadian specific data. So let's get through it as always. Now, there's an RBC study using the S&P TSX composite, which goes all the way back to 1990. And it found that investing the lump sum of money immediately outperformed dollar cost averaging in every single time horizon they tested. Pause. You will be surprised to know that the reason is almost very simple, because markets go up more often than they go down. So if you are holding half of your money in cash while you slowly invest into the market, the cash that isn't invested yet, the cash that you're still sitting on, is not earning the market's return. It's basically sitting there waiting to be invested, right? So since markets tend to trend upwards over multi-year periods, the more time invested usually beats careful planning. So think about it. Anyways, statistically speaking, if you've got like $10,000 to invest, or if you get a lump sum of money to invest, and you just put it out today, you'll probably come out ahead of somebody who spread that money over a period of time. And that's really what the research says. That's what the data says. And yet, I'll still tell a lot of people not to do that. And I'll tell you why. So if lump sum wins out most of the time, why would anybody bother spreading it out? Because the studies assume that once you invest, you will stay invested in the market no matter what. So think about it this way. Let's say you put $10,000 in the market on Monday, and by Friday, the markets go down 8%. Your account is already showing 9,200, right? On paper, nothing bad has actually happened. But in the moment, you feel terrible. And a lot of people in this situation, they don't really think that this is a temporary drop. They just think they've made a mistake and they will panic and they sell. The real damage happens because you reacted to a temporary market drop. Now, what DCA actually does is it softens that feeling instead of removing it altogether. So if you only put in $2,000 on that Monday instead of the full $10,000, that same 8% drop would only show up as a $160 loss on your screen, which is much easier to deal with and it's much easier to steer the course. So you are not getting better returns by spreading it out. Statistically, what you are probably doing is much worse, but you are buying yourself a better chance of actually staying invested when things get uncomfortable. And that consistency over years is worth more than squeezing out an extra 0.5% on your entry point. So think about this. A good plan that you stick with, it beats a perfect plan that you abandon halfway. So where does that leave my $200 a month setup? Where does that leave my $200 a month strategy, right? Here's what I love about it, and it skips the whole debate altogether. I never sit down and decide whether to go all in or spread it all out, because there's no lump sum of money to even think about. The money comes in from my paycheck and it goes straight into XEQT. So there's no moment where I'm staring at my account wondering if now is a good time to invest or not. Because the moment you start to question whether to invest or whether to hold, that exact moment is where indecision kicks in. And while you're waiting, the market is quietly going up without you. So with automation, that moment never really happens. That indecision moment, it never really happens. So I set it up once and it just runs. Whether the market goes up or down or it goes all over the place, my money still goes in. And it's not because I'm the most disciplined investing robot, but because I took the decision out of my hands and I just let an automated system do the work. If you have a lump sum of money, maybe you have a bonus or you ran into some cash at the corner of the street, or maybe someone just gifted you a huge sum of money, right? Or you have some savings that you've been sitting on for a while. Ask yourself an honest question. If you invest this money into the market at one single block and the value drops by 10% next month, are you going to be okay? Or are you going to panic and sell? If you're genuinely fine with your answer, that you're going to be okay, then you can go ahead and put it in the market, right? Because the data suggests that you're much better ahead that way. But if your answer is you're going to be stressed, then I'll suggest you split it over 3 to 6 months so that you even out the odds over those period of time. Now, if you're doing a regular monthly investing strategy, which is what most people actually do, then your choice is actually simple. Pick an amount that fits your budget, pick a low-cost ETF, and set a recurring buy option. If you want to see how I did my automated strategy, let me know and I'll make a video for that and I'll put it up on my channel very soon. Now, if you want to get started with investing, if you want to start buying into your TFSA, I showed the whole Wealthsimple investment process in my last video, and I'll drop that link right above my head. If this video has helped you in any way, please subscribe to my channel, drop a comment below, and share this video with somebody who will find it very helpful, and I'll see you on the next one.